Good morning, everyone. Thank you for joining us today again. Welcome to another Learn at UOBAM session. So let's start the session now. I'm Bart and I'll be your host today for the Learn at UOBAM session. Today's webinar is on the quarterly performance for Q2 2022. And before we kick off today's session, let's go through some of our housekeeping matters. Please note that this is a public webinar and you'll be recorded. The chat box is available. If you have any connectivity issues, you can raise them to the Zoom host and my colleagues will help you. Click on the Q&A icon to ask questions throughout the session, and this is important as I will be picking out questions from the Q&A to ask our panelists. Click on the like button to upload questions and that's raised in the Q&A session. And last of all, scan the QR codes with your phone to access the feedback form and download pages, or click on the links available in the chat box later. So the agenda for today is as follows. And without further ado, let us welcome a familiar figure, Mr. Dharmo Soejanto, for today. Hi, Dharmo.
Hi, Bart.
Hi.
Great. Good morning, ladies and gentlemen. Thank you for joining us for this session. Let me run through what happened this quarter and how the robo-advisor actually performed during this period of time. I think we all know that it's been a very challenging quarter. Market has actually been very, very tough for the first half of the year. First quarter was bad. In the second quarter, we've actually not let up. If anything, global equities continue on a downtrend. Inflation remains a major issue for everyone. And I think what you've seen is that US and Europe seen the highest inflation print in almost 2 decades. In June, I think the US inflation hit 9.1%. That's really the highest in more than 2 decades. So high inflation basically suggests that central bank would continue to raise interest rates. There's no letting up of interest rate hikes. And therefore, the equity markets have actually reacted negatively to that, right? So the sell-off basically has broadened. In the past, it used to be the very high growth stocks that were affected, but now even the stalwarts, the big names like Apple and Microsoft was also affected and sold off as well. So if anything, Asia actually has performed slightly better in the quarter. So the global market was down about 13.4%. Asia is actually down only about 6.7%. That's really because in China, there's expectation, or there's hope that the Chinese government would start relaxing COVID rules, meaning that the lockdown is actually gradually eased, and therefore economic activities would start recovering. I think there are some signs of that, but it still remains fairly tight, meaning that there are still regional lockdowns or lockdowns on certain part of certain cities, as long as there are COVID cases being detected. The latest, of course, was Macau that was being locked down as a result. So we have that sort of situation. It's gradually easing, but it's not life is not back to normal yet. That's the first thing. The second thing is, of course, there's expectation of more stimulus from the Chinese government. One is, of course, monetary policy is easing in China. They're starting to cut interest rates. And the expectation is that there are more fiscal stimulus that will be introduced in order for them to hit their growth target of 5.5%. So far, I think the first half of the year, they've not met that target. So there's expectation that the government may actually stimulate the economy a bit more in order to meet the full year target of 5.5%. I think that's probably a bit of hope in that. But it has been complicated by recent news of bank runs in China, as well as concern about homeowners or home buyers basically refusing to pay their mortgage. And that trend has actually started spreading to quite a number of cities in China. And we don't know how this is going to play out. So that's really one big wild card out there. So we are a little bit concerned, and we are watching that situation carefully. But I think for the second quarter, the better than expected performance out of China actually meant that Asia has actually performed better than expected. And of course, if we look at export so far, the export numbers from China as well as from Taiwan and Korea has actually been stronger than market has expected. So really, export is doing okay. The export market is still doing well, but basically they are concerned that high interest rate is going to start affecting consumer demand and the economy in the Western world, or in the US as well as in Europe. I think that's really the macro background that we are facing today. If we go to the next slide, the bond market has actually also been fared quite badly as well, because of the rise in interest rates. What we have seen is that the bond market actually sold off by about 4.3% on a global basis, right? The US Federal Reserve hike rates by 75 basis points. That's really the biggest increase since 1994, and that has actually affected the performance of bond markets, right? Asia, again, on the other hand, has fared slightly better, as we mentioned, because of the sharp sell-off in the first quarter. Second quarter, they've actually fallen a bit less. It's down about 1.3%. But on the high yield side, actually Asia fared quite badly, is down 7.3%. This is partially because of the Chinese real estate developers were downgraded due to concerns of the ability to repay debts. And of course, we know that Sri Lankan sovereign was actually also affected because of the turmoil in the country, right? So I think Asian, if we look at it, it has been dichotomous. It's been really a tale of two markets. High yield has actually fared badly. High grade is actually down, but it's actually down not as bad. Basically, this really brings the first half to a fairly difficult market, right? So if you think of it, in the past, when equity markets sell off, bond market actually tends to do fairly well and buffer the portfolio against equity market sell-off. But in the first half of this year, what we've seen is basically a correlation between bond and equities being positive and being very, very tight. So if we look at the bond market this year, first half of the year, bond market is actually down almost 10%. And equity market is down, roughly speaking, about 16%. If you talk about the high yield, or the sort of the more volatile part of the bond market, is actually down 20% this year, 25% this year. So really, it's really been a challenging first half, and it's basically not an easy market. I'll talk about the outlook at the end of this presentation, but let's look at what it means for portfolios currently, right? So for the corporate robo, what we've seen is for the first 3 months, that's really been down. For the last 3 months, it's actually down 6.7% for the very conservative portfolio. Actually, that the biggest pull was really on the Asian bond, right? Asian bond was probably one of the biggest drag and the biggest detractor for this performance. But really, if you think about it, every asset class have actually underperformed. Money market fund is probably the only one that has a positive return, but even Sing government bond and US government bond were affected by this sell-off, right? So for the first half of this year, the market is the portfolio is down about 13%. As I mentioned just now, if you have stayed in very strong, even if you stay in very investment grade bonds, the market would have been down about almost 10%. And I guess the Asian bond sort of detracted the portfolio a bit more for the first half of this year, right? If we go to the next portfolio, the conservative portfolio is down 6.1%. Again, Asian bond was the detractor, but to a certain extent, that has been partially helped by the Asian ex-Japan equity. As we mentioned, that actually is down a bit less, and that basically brought the whole thing down to about 6%. Money market fund is a fairly big portion of this portfolio, is about 23%, because since we've actually allocated some of the funds to equities, we have to balance it with more money market fund, and that has helped to reduce the exposure to both the bond and equity market, and that has helped the portfolio a bit. But roughly speaking, it's still down about 6% for the last quarter, right? If I go to the next one, this one, we don't have money market to help cushion, and therefore the portfolio is actually down 8.4%. In this instance, the Asian high yield bond really actually is a further detraction for the portfolio. Whereas the equity market, the Asian equity is the one that really is probably cushioning it a bit from the portfolio. The same government bond also is a bit of a cushion here, right? If I go to the next one, on the aggressive portfolio, basically in this instant, the Sing government bond is about 16%, and the Asian ex-Japan equity is about 21%. So this 36% is the one that really cushioned the portfolio, whereas the Asian high yield bond and the US government bond are probably the one that is dragging it down. For this portfolio, because of the gains that we have in the early part of the life of this portfolio, the portfolio since inception actually is about flat, right? But on a 6 months basis, this is roughly speaking down about 14%. This is what we expect, roughly speaking, from about a 50-50 portfolio between bonds and fixed income, between bond and equities. On the very aggressive portfolio next, is actually down 12%. This is a much more aggressive portfolio. Equities actually make up almost 75% of this portfolio, and it includes even Asian high yield bond. So on an overall basis, there's almost 90%, 80% of risky assets in this portfolio, and that's why the impact is really harder. And on a 6 months basis, this portfolio is down about 18%, which is roughly speaking about equivalent of what an equity portfolio would look like for this portfolio. And now, if I may, I'll move on to the retail robo. On this one, is really the Asian bond that really has affected the portfolio. The Asian bonds really has suffered quite a bit this quarter. There was a bit of the high yield inside the Asian bond or the emerging market bond. And as a result, this portfolio is down 8.2%, slightly worse than what you would have held if it's been 100% bond portfolio, right? So the ironically is the Asian ex-Japan equity, US and the US REITs that's actually sort of slightly helped this portfolio, right? If I go to the next portfolio, the more conservative portfolio, this one doesn't have Asian bonds. So as a result, there's actually 50% in US government bond because there's 50% in risky assets, including Asian high yield bond, global equity, Asian ex-Japan equity, and US equity. So on this 50-50 portfolio, we actually manage, well, actually 55% bond and 45% equity portfolio. We actually managed to deliver about minus 5.5% return, right? So that's the ironical part is because there is no Asian bond, we've actually done slightly better for this portfolio. If I may go to the next portfolio, this one, now the risk assets have gone up and therefore the returns have actually fared worse. It's down 7.1% because we have Asian high yield bond and we have more US equity, Asia ex-Japan equity, and US REITs. So roughly speaking, this portfolio is about 2/3 of in risk assets and 1/3 in US government bond. That delivers about 7.1% return. Okay, on the aggressive portfolio, this one, the risk assets are actually almost 80% in risk assets. And because of that, the returns are impacted harder. We are down about 9.1% on this portfolio. And on the last one, on the most aggressive portfolio, this is down 12%. As we mentioned, this is 100%, almost 100% equity portfolio. As we mentioned, basically there's the equities were down, roughly speaking, about 14%. That's been slightly buffered to a certain extent by the Asian ex-Japan equity, which is down less, but the US growth equities are actually down a bit more. So we even out that effect. We're down about 12.1% for this portfolio. And for this portfolio, because of the strong equity performance last year, the since inception performance actually is still a positive number, but definitely it's been a difficult quarter and a difficult first half. That's it for the portfolio performance. And where do we see market going from here? Excuse me. Right. So really, the big question that we have today is really on the inflation. And at this moment, inflation remains stubborn. And what we are concerned with is that inflation, goods inflation are starting to come off because the supply chain is starting to ease, given that China is gradually opening up, and supply chain is at least normalizing or abide at a very slow pace. So goods inflation are starting to come off. However, our concern is that service inflation is actually starting to pick up. So what we think is this: the headline inflation would start to come off going forward, simply because energy and food inflation would gradually ease because of the high base effect, right? Remember that at the beginning of the year, energy or oil price hit 100, and today we are still at 100. So if you think of it, roughly speaking, from the beginning of the year, if we end the year at about 100, energy inflation by the end of the year would be almost zero, right? So to us, what we can see is that the headline inflation will gradually come off simply because of the high base effect. But the core inflation would remain sticky because what we are seeing is that wage inflation is starting to pick up around the world, and that has translated to service inflation. So because of that, we think that the central banks around the world would basically continue to hike rates in order to tame that inflation expectation. Right. So what we see, what we think is that the central banks are prepared to engineer a mild recession, or what we call a soft landing, in order to bring in inflation expectation down. This is really something that they have to do, in a sense that because they couldn't fix the supply issue, they are now trying to fix the demand issue. Sorry, but excuse me. Because they couldn't fix the supply issue, they have to slow down demand as a result. And what they are trying to do is that they are trying to slow job growth without causing a big unemployment problem. Obviously, it is a delicate operation, and they need a bit of luck in order to achieve that, simply because interest rate is a very blunt tool, meaning, and usually there is a lag effect, and even the central bank can't control it very, very precisely. They can't control the response, the economic response to interest rate hikes very, very precisely. Right. So if under that sort of situation, there is still a chance for error, and there is still a chance for accident to happen. However, at this moment, we are still expecting a soft landing, simply because the current momentum is still very strong. Whether you look at retail sales in the US, whether you look at job numbers, it is still very, very strong. Right. So under this situation, we think that there is a lot of buffer for economic activity to slow before we really hit a recession, before we really hit a hard recession. So our expectation is still that there will be a soft landing, and inflation expectation, if anything, I think we have passed peak inflation fear. What do I mean? I don't mean that inflation has peaked. I think inflation there's still momentum in inflation, but but investors expect that central banks would be able to control inflation. That means central banks' credibility remains intact in terms of controlling inflation. Why do I say that? The expectation really is that for the Fed fund rate to peak at 3.5% by about mid next year, and after that, actually, the futures market is saying that Fed would start cutting rate by mid next year. So really, it's the expectation is that Fed will get its wish in terms of having a mild inflation, and after that, Fed can actually ease in terms of having to hike rates any further from there. And if anything, it could be that they would need to cut rates from there. That's market expectation. So basically, what we think is that the fear of inflation has passed its peak, which is why the 10-year yield has gone down from about 3.25 down towards below 3% today. Today is really, we are at about 2.8%, and that's basically signs that people expect that going forward, Fed would probably have to cut interest rates. right? So under this sort of scenario, we think that equities market would probably be a bit challenging given the slowdown in the economy. But we think that the bond market would actually normalize in terms of its relationship with the equity market, as well as in terms of performing more normally, meaning that delivering low returns with low volatility from here, right? So the wild card is really on the credit spreads, but I think on the rate side, we think that things have moved towards a more normal situation, and we expect in the second half of the year that the bond market would deliver low single-digit returns, as is what it is expected to do, right? And we basically closely monitor current situation. But what has happened is that the algorithm today is actually starting to guide us, given the higher volatility in market, is guiding us to allocate more towards fixed income and less towards equity in order to basically remain within the volatility target for each of your portfolio, right? So that's roughly speaking where the algorithm is guiding us towards. But from our point of view, you remember that we say that we have a CMA committee that watches the expected return and risk for each asset class that we have. And interestingly, at this current moment, we are actually we expect that the long-term return of most asset class to have actually improved, given that valuation has actually come off. Remember that last year, when valuation was expensive for both bonds and equity market, our long-term outlook for all asset class were actually lower than usual. So we were expecting only 1% return for bond market, especially for government bond, and for equities we were expecting about 4 to 5% return for equity market, right? For the next 5 to 10 years. Now, actually, our return expectation for all asset class have gone up because now valuation are actually at more reasonable level compared to what we had last year. So we are now expecting about almost 3% return from bond market, and we are expecting about 7% return from equity market simply because of this recent sell-off, right? So, but however, as I mentioned, given that the higher volatility in current market situation, the algorithm is really pushing us to put more money in bonds to ensure that we don't take the portfolio are not too volatile, and we would probably be shifting more towards equities much later in this year or even early next year when the volatility has subsided, right? So basically, with that, I've come to the end of the presentation. Happy to take any questions if you have, but are there any questions from the audience?
Yes, hi Dharmo. There's one question from the audience. Is on the retail robo, the very aggressive model, is there plans to rebalance it to tilt towards Asia plus China, or what is our strategy moving forward?
Okay. From a risk return point of view, Asia, because it's sold off so hard, actually represents a very attractive portfolio, a very attractive proposition. I think there is no doubt about it. However, Asia also happens to be the most volatile that we have seen. And as we mentioned just now, the concern is that there are still quite a bit of wild card in China. We don't know, although we know that government policies are very positive, but the housing bubble or the real estate sector is a big wild card and a risk factor. We don't know how it's going to play out. It is a very huge market, and there are a lot of instances in which that we see that that this could turn out badly, meaning that this actually we could see a burst in the housing market, and that could affect the financial sector or the financial system, right? So these are, and when that happened, I mean, if you remember our own housing market correction, or if you think of the Asian financial crisis, it could be very ugly and it could take years to repair. So it is something that we are watching closely. The answer is that we do allocate to Asia, simply because from a return prospect, it offers one of the highest returns given given the sharp sell-off. But the risk is also relatively high. So we are controlling it. We are allocating a portion to Asia, but we are controlling that exposure to ensure that we are not taking excessive risk for the portfolio, right? So roughly speaking, expect about 10-15% exposure for the most aggressive portfolio, and much less if the portfolio is really is supposed to be a little bit more conservative. I hope that answers your question.
Thank you, Dharmo. Wondering if there's any more questions from the audience. So you can post your questions in the Q&A, and then we will. Oh, there's one question. For allocations to bonds going forward, which is most attractive? Is the US government, Singapore government, or the high yield bonds?
When the economy is slowing down, usually high yield doesn't perform well. That's because the default risk goes up in this sort of environment. So high yield tends to be least attractive from a prospect point of view, right? It's going to be more volatile, and return could be actually a little bit more volatile from here. So on that front, we think high yield is least attractive. On the rate front, we think that rates probably is about fair. I would not say that. I mean, we are at a stage in which that we think that the upside and downside is probably about even, right? So that's really from a rate front. What I think is really attractive is short-term credit, right? So basically, the interesting thing today is that if you have followed, the yield curve has actually inverted. What do I mean? It means that the short-term interest rate is now higher than long-term interest rate. So 10-year US Treasury is paying about 2.8, but a 2-year US Treasury is paying 3%. Right? So imagine you have a corporate bond that a 2-year corporate bond. So you have 3% risk-free rate plus some credit spread. Today is probably about 150 basis points. So you get almost 4.5% coupon or 4.5% yield on short-term corporate bonds, on short-term corporate credits, right? And this is high-grade corporate bonds. So I think that's really an attractive proposition. So if you ask me which is probably the most attractive sector today, I'll tell you the short duration corporate credits are probably offering the best risk return profile. And at 2 year, you are not subjected much to interest rate risk, because when interest rate goes up, it actually affects these bonds very little. And you basically just collect 4.5% return for the next 2 years. So I think that's really a good proposition to be.
Thank you, Dharmo. So the next question we have is, when do you think the inflation will likely peak?
Sorry, from a headline point of view, I think that the inflation will probably peak by year end. As I mentioned, the energy inflation and food inflation would probably start flattening out during that period of time, right? So and basically the concern really is the service inflation, whether that would continue to pick up from there. And my sense is that with all these rate hikes, we are actually starting to see some of the leading indicators turning down, right? The PMI numbers are starting to come off. The job numbers currently is also starting to slow in terms of non-farm payrolls, and the initial jobless claims is starting to pick up. The housing market is starting to slow in the US because of the high mortgage rate. US mortgage rate is now 6%, and that is affecting people's ability to buy houses, and therefore housing sales are starting to slow. And so with all that, I think that in several months' time, the inflation will actually start coming off, right? So I think that puts us somewhere late in this year for peak inflation to happen. So I think I'll probably give it somewhere between, about roughly speaking, 6 months from now, 5-6 months from now.
Thank you, Dharmo. We have one last question, and that is, would interest rate swaps be attractive then, since the short-term interest rates are so high?
Unfortunately for this, for the robo-advisor, we cannot use complicated financial instruments for regulation purposes, right? We have to keep the financial instruments we use simple, which is why we tend to use ETFs as a way to express our views. So unfortunately, we can't use things like interest rate swaps. But for people who can, for investors who can, yes, sure. I mean, interest rate swaps, definitely, if you can swap out your long-term rate for short-term rate, that's actually pretty attractive.
Thank you, Dharmo. I think we have answered all the questions. So thanks for going through the Q2 performance and the Q&As. So guys, do sign up to our mailing list if you would like to follow our investment experts' views and the research notes that we produce. Before we go, I would like to share 2 UOBAM Invest promotions with you today. From 21st July onwards, top up $500 of fresh funds in a single transaction to your account for the first time, and you'll receive $20 credit. Terms and conditions apply. And the second promotion that we have is you get up to $50 of credits when you set up a 12 months regular savings plan with a minimum monthly contribution of $300. Terms and conditions apply too. Do visit our website for more information on our performance and the latest promotions that we have. And please kindly scan the QR code for feedbacks and suggestions. And with that, we have come to the end of today's session. I hope you found the session informative and do join us for future sessions. Remember to sign up for our mailing list and our future webinar invites as well. Thank you and goodbye.
Thanks, everyone. Bye-bye.
Bye.